Artificial intelligence is everywhere. From chatbots and automation tools to data centers and self-driving technology, AI is no longer futuristic. It's here. And naturally, investors are asking one question. Is it too late to invest in AI? Before you put a single dollar into any AI stock, there are a few critical things you need to understand, because investing in AI is not just about buying a popular company, it's about understanding the structure behind the hype. In this video, I'll explain what AI investing really means, the biggest risks you need to consider, and how beginners should approach this sector intelligently. What does investing in AI actually mean? When most people say they want to invest in AI, they usually mean buying one famous company. But AI investing is much broader than that. There are multiple layers to this industry. First, you have hardware companies. These are the companies building the chips and processors that power artificial intelligence systems. Without hardware, AI cannot function. Second, you have cloud infrastructure companies. AI models require massive computing power. That computing power runs in data centers around the world. Third, you have software companies. These are the firms building AI applications, from enterprise automation to creative tools. And finally, you have AI-focused ETFs, which bundle multiple companies into one investment. Understanding these layers is important, because not all AI investments carry the same risk. The hype cycle. Every major technological breakthrough goes through a cycle. First comes innovation, then excitement, then massive hype, and sometimes correction. We've seen this before. The internet boom in the late 1990s brought incredible innovation, but it also brought extreme speculation. Many companies had no profits, yet their stock prices skyrocketed. Eventually, reality caught up. The lesson is not that technology fails. The lesson is that valuation matters. AI is transformative, but transformative technology does not eliminate volatility. Prices can rise quickly, and they can fall quickly. As an investor, you must separate belief in the technology from expectations about stock performance. The biggest risks in AI investing. Let's talk about risk. First, valuation risk. When a sector becomes popular, investors often overpay. If expectations are too high, even strong companies can see their stock decline. Second, competition risk. AI is highly competitive. New models and breakthroughs appear constantly. Today's leader may not dominate forever. Third, regulatory risk. Governments around the world are still defining rules for artificial intelligence. Regulation can slow growth or change business models. Fourth, profitability risk. Some AI companies generate enormous revenue. Others generate attention, but not profit. As an investor, revenue growth alone is not enough. You must look at margins, cash flow, and sustainability. Understanding these risks does not mean avoiding AI. It means approaching it realistically. 3 ways to invest in AI. There are generally 3 main approaches. First, individual stocks. This offers the highest potential upside, but also the highest risk. If you choose correctly, returns can be strong. If you choose poorly, losses can be significant. Second, AI-focused ETFs. These spread your investment across multiple AI-related companies. This reduces company-specific risk. Third, broad market index funds. Many AI companies are already included in major indexes. By investing broadly, you gain AI exposure without concentrating your portfolio. The right approach depends on your risk tolerance. How beginners should approach AI. If you're just starting, AI should not be your entire portfolio. No single sector should dominate everything. A disciplined approach might look like this. Keep the majority of your investments in diversified index funds. Allocate a smaller percentage to AI exposure. This allows participation without overexposure. Remember, concentration creates volatility. Diversification creates stability. The goal is not to chase momentum. The goal is to build sustainable growth. Long-term perspective. Artificial intelligence will likely shape the next decade of innovation. Automation, healthcare, logistics, finance, AI will influence them all, but investing success is not about predicting headlines. It's about managing risk over time. Markets reward patience. They reward structure. They reward discipline. If you believe in AI long-term, build exposure gradually, rebalance when necessary, avoid emotional decisions, and most importantly, understand what you actually own. Final thoughts. AI is powerful. It is transformative, but it is not magic. Stocks can still fall. Hype can still fade, and cycles still exist. Smart investors don't invest blindly. They analyze structure, they manage risk, they think long term. If you approach AI investing with discipline instead of emotion, you give yourself the best chance to benefit from this technological shift. This is not about getting rich quickly. This is about positioning yourself intelligently for the future. Invest smart. Think long term.